Welcome to the CFA Level 1 presentation on portfolio risk and return. This lecture corresponds to reading 52 in the 2011 CFA Level 1 curriculum. So first, a quick review of major return measures, and this is important because whenever you are talking about a portfolio of investments, you are concerned about what sort of return you are getting. And this material you have seen before in quantitative methods, so I won't spend much time on it, just a very quick review. Holding period return simply means what is the return you are getting over a given holding period return. Let's say that the holding period is 6 months and you bought a stock for 50, which is now 60. Your holding period return is 20% because 10 over 50 into 100, so your holding period return is 20%. Most returns, however, are stated as annualized returns. So if your holding period return for 6 months is 20%, the annualized return would be equal to 1.2 squared minus 1. So this would be approximately a little more than 40%. So that's your holding period return. Average return is simply there are several measures of average returns, one being the arithmetic mean return, which is generally used when you compare cross-sectional data, geometric mean return, which is used with time series data, and money weighted return, which is simply the internal rate of return on a portfolio or an investment. Not explicitly mentioned here, but in quant you also studied time weighted return, and if you don't remember these terms, make sure you go back to readings 5 and reading 6 in quant to refresh yourself on this material. It is important. Other return measures, gross return versus net return, and this is an important distinction. Let's say you invest in a mutual fund, and the mutual fund in 2009, let's say, gives you a gross return of 20%. Gross means the overall return on the mutual fund without fees and expenses subtracted. And if the fees for 2009 and expenses amounted to about 2%, then your net return would be 18%, which is the gross return minus the fees / expenses. Investors would be concerned about their net return. Pre-tax nominal return, so this is, as the term implies, your nominal return. In general, returns, unless stated otherwise, are nominal. Nominal means that inflation is built into inflation numbers are built in. So pre-tax means what's your return before taxes, and then after-tax return, which is what most people are concerned with, is the return once taxes are taken out. And given that different investors have different tax rates, the investor ultimately is concerned about his after-tax return. Real return is the return with inflation taken out. So very roughly speaking, if inflation is equal to 2% and your nominal return is equal to 6%, that means your real return is approximately equal to 4%. So remember, we discussed this in both quant and economics. And since this is important enough, I'm just going to very briefly show you the relationship. So 1 plus your nominal return is equal to 1 plus the real return into 1 plus inflation, and the linear approximation for this is that your nominal return is approximately equal to your real return plus inflation. With small numbers, these two expressions are roughly the same. A leveraged return is the return that you get when you take leverage or when you use borrowed funds to make an investment. The return then is referred to as a leveraged return. Characteristics of major asset classes. So in the context of portfolio management, you need to understand what the term asset class means. Asset class simply means, so I'll just explain this through example. Major asset classes would be stocks, bonds, commodities, real estate, etc. So these are different asset classes. When you make investments, the first level decision is which asset classes to put your money into and in what percentage. So a very simple division might be something that says put 80% of my money in stocks, 20% in bonds. So then we are saying that the only two asset classes we are invested in this simple example would be stocks and bonds. Now within an asset class such as stocks, there are sub-asset classes. So with stocks, for example, we have small cap stocks, large cap stocks. We can also have mid cap stocks. Small cap stocks refers to stocks with small overall market capitalization. Market capitalization, remember, is equal to the number of shares outstanding times market price. So small cap would have, let's say, market cap less than, say, 500 million. Large cap stocks would be stocks with very high market capitalization, not shown here, but you can also have mid cap stocks which would fall in between. So in the stock category, these are two typical asset classes. In the bond category, you can have long-term corporate bonds. In Pakistan, these are referred to as TFCs. You can have long-term treasury bonds, short-term government bonds, which are referred to as T-bills. Inflation is not really an asset class, so inflation actually we should mention separately, but in any investment analysis you need to consider inflation, and ideally you want that your return on asset classes should exceed inflation. Now I would encourage you to go through the curriculum, and if you look at Exhibit 5 in the curriculum, that will give you the approximate average returns and standard deviations of different asset classes. And the general idea, you don't need to memorize this exhibit, but generally need to understand that small cap stocks in general have had a high average return, but the standard deviation, which is a measure of the riskiness, has also been high. So small cap stocks, high return, high risk. At the other end of the spectrum, you have T-bills, which have very low return, and then the risk over here is actually the lowest. So these are generally considered risk free, which means that, say, in Pakistan, T-bills have an approximate return of 13%. If you invest in a T-bill, you are guaranteed that 13%. So in that sense, you are not taking a risk. And then various asset classes will have a certain expected return and standard deviation. The simple principle that you need to keep in mind is that the higher the expected return or higher the average return, higher the general riskiness associated with that asset class. This is another general slide talking about evaluating investments. So using expected return and variance is a simplification because returns do not follow a normal distribution. The point here being the following, that in most of portfolio management we make an assumption that investment returns follow a normal distribution, which means that for every investment we assume a certain expected return and a certain standard deviation, and we assume that the returns are normally distributed. This makes the calculations somewhat easier, but all that we are warning you about here is that while this is used in a theoretical sense and this is a reasonable approximation, but you need to be aware that in the real world we will have kurtosis, skewness and liquidity issues. Again, this is a quick revision from quant. Kurtosis means that you have that actual distributions might have fatter tails and higher peaks than normal, so this would be excess kurtosis. Skewness means that returns might be, say, skewed to the right or skewed to the left, so this would be an example of a right skewed data, the mirror image of this would be left skewed. Liquidity means that certain stocks or investments might have liquidity issues. In Pakistan, for example, corporate bonds or TFCs have a liquidity problem, which means that even though the market price might be 98% of par, but if you cannot easily sell this, then effectively using this market price might be somewhat misleading. Okay, another important concept is that of covariance and correlation. You've seen this in quant also. Covariance is the extent to which two variables move together over time. So if you have two stocks A and B, if in general they move up together and down together, then we say they have high positive covariance. If they generally move in opposite directions, then they have negative covariance. And if they don't move together in terms of, in other words, their movement is unrelated to each other, then covariance is 0. The formula for covariance depends on whether you are dealing with a population or a sample. So just to keep this simple, let's say you are looking at stock A and looking at the covariance of stock A with the let's say with the economy. So there are three states of the economy: good, bad, average. Then when you calculate covariance, if you are looking at all possible states, then the formula of covariance will use this formula. So it will be basically this formula, which is the population formula. And I'm not going to go over this in detail, just very briefly. What we are doing is, if we have two variables A and B, and you are looking at their covariance in all states of the economy, I is equal to 1 to 3. Let's say there are three states. Then I will go from 1, 2 and 3. So first we'll take state 1. This is the probability of state 1 first. The return in state 1 of stock 1 minus the expected return of stock 1 multiplied by the return in state 1 of stock 2 minus the overall expected return of stock 2, and then do the same when I is equal to 2, that's the second state of the economy, and then again do an I3, which is the third state of the economy, and add all three up. So that was a quick review. If you have trouble understanding this, go back to the quant lectures and you will see this in detail there with an example. Sample covariance means that you are looking at a sample. Now if you are comparing returns of stock A and B, or actually I should call this stock 1 and stock 2, then if you are looking at the covariance between these two, and you just take, say, the last 12 months worth of data, even though these two stocks have been around for, say, 20 years, then you use this formula. Here again you go I is equal to 1 to n, and then for each combination of 1 and 2 you plug in over here. Actually this is t, so you go from t is equal to 1 to n and use this formula. A distinction here is just a slight difference between this formula and this formula. This term over here, again, this is actually the expected return. So I should say expected return of R1, expected return of R2, and then we divide by n minus 1. N is the number of observations. So in my example, if we have 12 months, then n minus 1 is, so this would be 11, and so on. So again, this is described in more detail earlier. So if you're struggling with this, go back and look at the relevant quant lecture. Correlation is represented by the Greek symbol rho, and correlation between 1 and 2 is equal to the covariance between stock 1, stock 2 divided by the standard deviation of 1 multiplied by the standard deviation of 2. So the correlation basically is a standardized measure. The issue with covariance is you might have a covariance of plus 79.25. All this tells you is that the covariance between 1 and 2 is positive. What it doesn't tell you is whether this is a strong covariance or a weak covariance. When you standardize by dividing by the standard deviations, then you will get a number between -1 and 1. A correlation of 1 means that there is a perfect positive correlation. When stock 1 goes up, you can be sure that stock 2 goes up. A correlation of 0 means that there is that the two variables are completely independent. And a correlation of -1 means that if one stock goes up, you can be sure that the other one goes down. So generally we use the correlation, but as you can see, the correlation can easily be derived if you are given the covariance. Now, how do we apply this to portfolio theory? Let's say that you have a portfolio of two assets, asset A and asset B, and let's say that 60% of your portfolio is in A, 40% of the portfolio is in B. Let's say that the standard deviation for A is equal to let's say 15, and the standard deviation of the returns for B is equal to 20. So B is more risky. And how do you calculate the standard deviation of the portfolio, which is a combination of A and B? For this, we also need to know either the correlation or the covariance between A and B. So let's say that the correlation is 0.5. The formula then for the standard deviation of the portfolio of two assets is given by this equation. So this would simply be equal to the square root of W1 squared, which is the weight of asset 1. In this case, that's 0.6 squared multiplied by sigma 1 squared. So sigma 1, let's just take these in terms of a decimal. So times 0.15 squared plus the weight of 2, which is 0.4 squared, times sigma 2, which is 0.2 squared, plus 2 into 0.6 into 0.4 into the correlation, which is 0.5, into the two standard deviations, which is 0.15 into 0.2. So this would give us the standard deviation of the portfolio. Notice that if instead of this you were given the covariance, then you can still solve the problem. Why? Because essentially notice that given the equation I showed you on the earlier slide, the covariance between 1 and 2 is simply equal to the correlation between 1 and 2 times sigma 1 sigma 2. So given this relationship, it doesn't matter whether you are given the covariance or the correlation, you can still find the expected, you can find the standard deviation of the portfolio. So now look at the important role played by correlation. If the correlation between the two investments A and B is equal to 0, then this whole expression cancels out, because you would have a 0 over here, and that would reduce the overall that would reduce the riskiness or the standard deviation of the portfolio. In fact, the riskiness of the portfolio will be the highest, or sigma p would be high when the correlation is equal to 1, and sigma p could actually be the lowest when the correlation is low. So I would actually, if this sounds strange, then I would encourage you to calculate this number for a correlation equal to 0.5, and then also find out what sigma p is for correlation equal to 1, correlation equal to 0, correlation equal to minus 0.5, and correlation equal to minus 1. And you will automatically then see the relationship that higher the correlation, higher the riskiness. Okay, let's illustrate this graphically. Let's say that you have two stocks, stock A and stock B, and let's say that we want to create a portfolio of these two shares. Now let's say that stock A has a expected return. So let's say expected return of 10% and stock B has a expected return of 20%, and the riskiness of A, let's say, is equal to 15%, and the riskiness of B, which will be higher because the expected return is higher, let's say the riskiness of B is equal to 30%. So if you create a portfolio that is 100% invested in A, okay, then the expected return of the portfolio would be 10%. So let's say that this portfolio represents 100% A. Then the expected return would be 10%, so that's this point, and the riskiness of this portfolio represented by the x-axis would be 15%. On the other hand, if you create a portfolio that is 100% B, then you would have this spot over here with a expected return of 20% and a riskiness of 30%. What happens if you start to diversify? So now you create a portfolio, let's say, with 30% A and 70% of your money goes into B. What is the expected return of this portfolio? The expected return of this portfolio would simply be 0.3 times the return of A, which is 10%, plus 0.7 multiplied by the return of B, which is 20%. So this is equal to 3 plus, so 0.3 plus 0.7 into 20, which is 14. So your expected return is going to be 17%. So let's say that this point, for example, represents 30% A and 70% B, 30% A, 70% B. So just to highlight the fact, as we move along this line, all we are doing is changing the relative weightage of A and B. So starting with this point, 100% A, and as we move along, we reduce the weightage of A and increase the weightage of B. And notice that initially when we do this, we are going to get a diversification benefit. How do we get that benefit? By seeing that we can increase the expected return to 17%, but can we do this by reducing risk? So that would be a diversification benefit if we can increase return and reduce risk. How do we come up with the riskiness of this portfolio? Remember from the formula that you just saw on the previous slide, the riskiness of the portfolio again is measured by this formula. So sigma of the portfolio is equal to the weightage. So let's say we are taking this point where we have 30% A and 70% B. So since this is important enough, I will write the formula again. So this is W1 squared sigma 1 squared, sigma 1 represents A, plus W2 squared sigma 2 squared, plus 2 times W1 W2 and then rho, which is the correlation between A and B, times sigma 1 sigma 2. And then if you plug in the numbers, you plug in W1, which is weightage of A, 0.7 squared, times the standard deviation of 1, which is given as 0.15 squared, and so on. If you plug in all these numbers and calculate the standard deviation of this portfolio, you should get a number that is less than 15%. So that is telling you that you can create a portfolio where the standard deviation is lower, that means the risk is lower, but the expected return is higher. So this classic example shows the benefit of diversification when you have two assets with a correlation that is less than 1. Now we are going to demonstrate that what is the impact of different correlations on the on diversification benefit. So again, let's say that we have asset A and asset B, and we are going to look at the return versus risk of different portfolios assuming different correlations. So let's first assume that the correlation between A and B is equal to 1. If the correlation between A and B is 1, then as we move along this line, so this line represents, so this point A represents 100% of A, this point represents 100% of B, and as we are moving from A to B, all we are doing is changing the relative weightage of A and B. So like at the halfway mark, we would be 50% A and 50% B. So with a correlation of 1, what happens to expected return? Expected return at the midway point would simply be the average of A and B. So if the expected return of A is 10% and the expected return of B is 20%, then the expected return of a portfolio that's 50% A and 50% B is simply 15%. But the point here is that as we change the weightage, we are not getting any diversification benefit, because as the weightage of the higher risk and higher return stock B is increasing, the riskiness is also increasing. So we are getting a higher expected return, but at the cost of higher risk. So there is no diversification benefit. Now let's assume that let's assume that the correlation between A and B is 0.5. Okay, so then we will get a slightly different curve. So here we are now assuming that correlation between A and B is 0.5. Then notice that there is going to be some diversification benefit. Again, as we move along this curve, we are saying that the correlation between the two stocks is the same, which is 0.5. What is changing as you move along this line is the weightage. So at this point we are 100% A, maybe at this point we are 30% A and 70% B. So given that the correlation is less than 1, we have a diversification benefit, and this is what was shown on the earlier slide too. If the correlation is 0, then we will have an even greater diversification benefit. Okay, so by greater diversification benefit means that we can increase the expected return and keep reducing the risk. So as long as we are increasing expected return and reducing risk, that is referred to as diversification benefit. The highest diversification benefit we can get is in this situation, where it is theoretically possible to get a risk equal to 0 when the correlation is equal to -1. So if A and B have a perfect negative correlation, we can figure out a certain weightage of A and B that gives us a reasonable expected return between 10 and 20% at 0 risk. But this is just a theoretical limit, because finding two stocks with an expected with a correlation of -1 is nearly impossible. But nevertheless, theoretically speaking, if you do find this, then there is a certain weightage of A and B where you can get a decent return with 0 risk. Key point here being that as long as your correlation goes down, the diversification benefit goes up.